This is going to be a masterclass series on net lease REIT investing.
It doesn't get any better than triple net lease REITs.
There's close to $14 trillion of opportunities that these REITs can continue to scale their businesses.
It seems like the landlord holds all the cards here.
The net lease sector is the second best performing sector today in the REIT universe.
This is one of the most enjoyable wide moat shows that I've participated in. This is Brad Thomas Unleashed.
Hi everyone, it's Brad Thomas and welcome back to the Wide Moat Show. I'm joined today with my co-host Nick Ward. Nick, it's good to see you today.
Yeah, good to see you, Brad. Happy to be here. Another Monday, green day in the stock market. So, all's good in the Ward household.
Well, green day in the stock market, but let's talk about your football match first. I know you're 0-1. So what happened this weekend?
Yeah, we won. So 1-1, 38-0. It's pretty hard to pitch a shutout in high school football. There's always one thing that's going to go wrong, but we played flawlessly. Proud of the guys' effort. I felt a lot. My weekend was a lot better this week than it was last weekend for sure. So happy to carry that into the next week. We've talked about playing defense a lot in our last couple episodes on this YouTube channel, talking about defensive stocks, high yields, etc. So I think we're going to run with that theme again this week. In honor of my guys and also in honor of potentially a big rate cut that we see in the near term.
Yeah, absolutely. And of course, today is really a special day. I'm not wearing the outfit, Nick, like you with tech. Maybe I should have worn a jacket. But today we're going to be talking about really what my favorite property sector in the real estate universe, which is net lease REITs, which I think the number one catalyst, and I've been saying this for months and quarters, if not years. But cost of capital is extremely important for net lease REITs. And we're going to talk about that here shortly. But switching from football to basketball. Basketball, of course, is my favorite sport. I played college basketball and I love the sport. I gave up active participating a couple of years ago with too many injuries. But today I'm going to title this series, Nothing But Net, in honor of my basketball days, but also this is going to be a masterclass series on net lease REIT investing.
Yeah, well, you got to love net lease REITs. We've talked about them a lot. There's basically the highest yielding margins that we see across all of Wall Street. And that includes software as a service. That includes some of these, fintech, wide moat, toll-proof type businesses. It doesn't get any better than triple net lease REITs. So I'm going to let Brad, he's the REIT master, basically run the show. In this video, I will ask questions here or there. But Brad, I'm just going to turn it over to you. Explain to the people, I guess, first of all, what is a triple net lease REIT if they're not aware? And then let's get into what are you going to do? You're going to do REITs to avoid, kind of the JV team, REITs that you like a little bit, and then the Fab Five, the 5 REITs that you would love to buy today. Pretty
much, you nailed it. And at the end of this YouTube, hopefully everyone who's watching knows a lot more about net lease REITs. Again, this is a master class in the sector of net lease investing. So first of all, a net lease REIT is a company that invests in freestanding, that's standalone with four walls, standalone buildings operating under a triple net lease structure. Now, in my REITs for Dummies book, which I published last year, I said that net lease refers to a rental situation where the renter pays for some, if not all, of the property taxes, insurance, and maintenance of the property. So in most cases, these lease contracts are long duration contracts, which the landlord can agree to a 10, 15, or 20-year lease with the tenant. And of course, that's with options to renew. Now, these lease contracts also have rental increases, which is important, that provide the landlord with a high degree of predictability as it relates to future cash flows. And this steady stream of rental income is one of the primary attractions or benefits to this property sector. Instead of dealing with aggravations related to the taxes, the toilets, or the tenants, I refer to these as the 3 T's. The net lease landlord can just sit back and collect the rent with no strings attached. Now, when I first started covering net lease REITs, it was around 2010, and there were just a handful of REITs. Companies like Realty Income, National Retail Properties, Agree Realty, WP Carey, and EPR Properties. However, this sector has grown dramatically. It is very fragmented. It's perhaps the most fragmented property sector. I'm going to pull up a chart here, and you'll see in the U.S., there's $5.5 trillion of investable net lease or freestanding properties. And in Europe, there are over $8.4 trillion of net lease properties that you can invest in. So you add it all together, there's close to $14 trillion of opportunities that these REITs can continue to scale their businesses by consolidating this very highly fragmented marketplace.
Well, I think that's a great point too, right? Because we talk about consolidation implying M&A, and that proves the two biggest companies could gobble each other up, and there still wouldn't really be a lot of antitrust argument to be made, because the vast majority of the real estate, in the Western world is privately owned. It's not in the public sector, so there's not a lot of kind of arguments to be made that there are monopolies being formed. Even the largest REITs in general, we're talking $50 to $100 billion market cap. Well, that's nothing compared to $14 trillion worth of the overall real estate pie. And then before you continue, Brad, my parents always told me if something seems too good to be true, it probably is, right? So this triple net lease agreement where the landlord is off the hook for all the expenses, the building maintenance, the taxes, the insurance, et cetera. Why would a tenant sign up for that, right? That's something that I'm assuming people are listening to right now wondering the same question. What's kind of in it for the tenant? Because it seems like the landlord holds all the cards here.
Yeah, that's true. And look, I think the major advantage for the tenant to lease versus own is cost of capital. I mean, we're going to be talking about cost of capital for these net lease REITs, but the company, pick a Dollar General or Tractor Supply or hundreds of these companies, Amazon, Home Depot, Lowe's. The company is better off renting and removing that asset from their balance sheet, because they can take that capital and reinvest it back into the business at higher returns than they could by owning real estate. That's the primary reason to do that. And the company can scale their businesses much, much faster because they're using OPM. That's other people's money. Now, there are 21 REITs today, Nick, and I promised Juan, our producer, that I was going to stay on time, and I owe it to our audience here. So I'm going to move through these names very, very quickly. There are 21 companies in the net lease space. 21 companies, way too many, by the way. And I think we'll talk about M&A and some potential M&A opportunities. That represents $161 million or 200 in market cap, or $230 billion in enterprise value. Again, this is a very fragmented space. I'm going to pull up this chart. It shows all the constituents here listed all the way down from the smallest, which is Generation Income, ticker GIPR, to the largest, most dominant player, Realty Income, with a $54 billion market cap. Now, the average dividend yield for this sector is 6%. Compare that with the broader equity REIT universe, which is 4.8%. Again, that's the appeal to this sector, is you have higher yields. Also, the payout ratios, which is good, we're going to talk about here shortly, varies from 109% payout ratio, which, by the way, that's a sucker yield, down to 64%, which is a very low payout ratio, which makes that dividend extremely safe. Now, the average multiple for the net lease sector is around 13.6%. So there's some real bargains here. Compare that to 15.5 times for industrial REITs, or 13.8 times for cell towers, or 25 times for data centers, or even 31 times for apartments. So certainly you're seeing undervalued companies within the net lease sector. Again, I've got that chart here. You can see that. Now, let's compare year-to-date performance of the net lease REITs. You can see a range of from negative 48% to positive 32%. That's year-to-date performance. By the way, the net lease sector is the second best performing sector today in the REIT universe. The best performing year-to-date is healthcare. And by the way, I wrote a healthcare REIT article this week. You can see that on the widemoatdaily.com. So please click on to widemoatdaily.com. You can see all of our free research. And this week, I have a healthcare REIT article there as well, which I think you'll enjoy. Now, look at the 5-year performance of these net lease REITs. You can see a lot of different colors. Obviously, a lot of different companies perform better than others. What we want to see is consistency. And obviously, in the net lease sector, over the last 2 years at least or longer, we've seen just a lot of pressure on net lease REITs because of the elevated cost of capital primarily. Now, for years on Seeking Alpha, I put together what's called REIT bracketology, where I rank each REIT sector similar to college basketball's March Madness. I'm sure you've seen that or you're familiar with that. Now, as I said, there are 21 net lease REITs, and I'll be discussing each of them here and provide viewers with a similar bracketology style update, concluding with the Fab Five net lease REITs. So make sure you watch this entire masterclass. Now, before I get started, and again, I'm going to go through these names pretty quickly, I want to discuss fundamentals. Because, Nick, just like your football team there, and just like basketball, you've got to understand fundamentals. One thing I did when I played basketball, I think I shot more free throws than anybody else. I used to think I was better than J.J. Redick, who I know still has probably the all-time record of the best free throws. But consistency. And I like to see the strong fundamentals, strong balance sheets, strong earnings histories, and strong dividend growth. And so we're going to be looking at each of these companies very quickly. I'm going to go through these quickly, looking at their fundamentals. Now, I can't ignore the cost of capital for these companies. As I mentioned, with the interest rates coming down, it's going to improve the cost of capital for all of these companies, which is going to allow them to generate more earnings per share, or AFFO, we call it in REIT world, and dividends per share. Now, I've included this chart here, which I put this chart in my book, The Intelligent REIT Investor, that shows the cost of capital for, I'll just use this for net lease REITs, for example. And you can see here that in the upper right-hand corner, you can see a company with a higher cost of capital forces the company to invest in riskier properties. And we're going to talk about some of those riskier REITs who invest in riskier properties here in a minute. The lower left quadrant of this chart shows the lower cost of capital companies that allows them to invest in higher quality opportunities and generate really the same investment spreads or the same profit margins. Now, without further ado, let's get started. First, there are 5 net lease REITs I would avoid at all costs, starting with generational income properties. That ticker is GIPR. As you saw previously on this other chart I had, the performance absolutely pathetic. This company is a train wreck. Now, they initiated a review of strategic alternatives a couple of months back, so they're looking to figure out, if they're going to get sold or bought. But just look at the performance. I've included each of these picks. I've got an earnings, an AFFO per share chart, and a dividend chart. Just look at the declining AFFO. This is a company that does not know how to create value whatsoever. So
tell them what you really think, Brad.
Yeah, almost didn't include this in this one, but I owed it to our audience. Next, we got Global Net Lease, ticker symbol GNL. Real popular company because they have a high yield. But again, 911 properties, that sounds pretty good. Sounds diversified. 44 million square feet, that's a big portfolio. Industrial properties, they got 200 of those. Retail properties, 600 of those. And single tenant office properties, 64 of those. However, look at this chart. This company has been a chronic dividend cutter. How does a net lease REIT cut the dividends so much? So again, I'm going to write this one off. Global Net Lease, avoid. Number 3, REITs to avoid. We have One Liberty Properties, ticker symbol OLP. Smaller company, 105 properties, 11.7 million square feet. Now look at this chart. You can see here, they've got really flat earnings, or AFFO per share, and flat dividends. I mean, this company does not know how to grow its dividend. At least for the last 5 or 6 years, all we've seen is flat dividends. I'm sorry, I'm going to write this one off. Plus, that payout ratio is not too stellar either. It's somewhere in the 92% range. So again, avoid One Liberty Properties. Next, we have Gladstone Commercial. Ticker's good. Yeah, I didn't make it up. Ticker's good, but it's bad. This company's got 143 properties in 27 states, 17 million square feet. Now, if you were watching me on Seeking Alpha, I called the dividend cut. I said, dividend cut's coming, because we could see they didn't have the payout ratio was elevated. It was above 100%. Guess what? You can see this on the chart. They cut the dividend, and they've had no growth. This company has been flat as a pancake. I would definitely avoid Gladstone Commercial. There is no value creation process whatsoever with this net lease REIT. Finally, and I know I'm going to get some debate with EPR Properties. This is the 5th REIT to avoid. EPR Properties, 329 properties, 151 theaters, 58 eat and play restaurant properties. That sounds fun. 11 ski resorts, 23 fitness and wellness facilities, 4 experiential lodging properties. Lodging scares me, by the way, getting into that sector. So what they've done, I'll give EPR credit. They've evolved from a pure play theater REIT. They started out as AMC as their only tenant, and they grew that theater portfolio. But just take a look at this chart. Look what happened in 2020 and 2021. Obviously, 2020 COVID, nobody's going to the movie. Look at that earnings stream. There was no rent coming in hardly. They slashed that dividend. But if you look at this chart closely, their dividend still and their earnings still has not recovered to pre-pandemic levels. Also, their cost of capital is elevated, which again, when you go back to the chart I showed you in that upper right corner, their cost of capital has forced them into acquiring riskier properties like these experiential hotels that they've invested in and numerous other things. So I'm avoiding this one simply because of the still concept. They still got fairly high concentration in theaters, although they've done a good job of diversifying, but also their elevated cost of capital. Now, the next 10 REITs I'm going to go through real quickly are what I call the JV team. These are the companies that I think could be, they're not the best, but they're the up and coming. So first we have Modiv Net Lease, ticker MDV, small portfolio. This is a small cap company, 42 properties located in 15 states. Dividend yield is 7.5%. Again, we don't have a lot of history here. You're going to see with this chart, they're starting to grow. They've grown their dividend, grow their earnings. Still not a lot of history yet, but I think the 7.5% dividend is safe. You're just not going to get as much price appreciation out of this one. Next, we go to Postal Realty, PSTL. What do? All they do is invest in post offices. They have over 1,800 properties in 49 states, the largest landlord to post offices, and they have a 99.8% occupancy rate. Now, one concerning factor, their weighted average lease term is just around 4 years. However, they've got a 99% historical retention rate, which is very important in terms of continuing to get those rent checks. Also, you can see this on the chart. I really wanted to point this out. Their AFFO, their payout ratio, which is the difference between the blue line and the orange line, has really started to widen, which has created a much safer dividend. Right now, the dividend yield is yielding 6.1%, and their price to AFFO is 13.1 times, well below the normal valuation, which is around 16 times. So Postal is definitely one to take a look at. Now let's go to Getty Realty. This is an M&A target, in my opinion. Getty's been around a long time. They started out in the convenience store industry, and they've continued to evolve now more into the fast food space as well. Getty has over 1,000 properties, 1,100 properties in 44 states. Dividend yield is 6.5%, and the valuation multiple is 12.1 times versus their normal of 15 times. So I definitely see some valuation here. If you look at that chart, you can see they definitely got hammered coming out of the Great Recession, really in 2011 and 2012. But the company has been able to really grow their earnings stream. I give them a lot of credit, and that's reflected in the chart. Again, this goes back to fundamentals. So I definitely think Getty would be an interesting company. And again, I think that could definitely be a potential M&A target. Next, we're going to go over to the casino space where we have gaming and leisure properties, GLPI. Again, this is an M&A target potentially. They have 68 properties in 20 states, over 15,000 hotel rooms, but these are net lease REITs, so they don't actually deal with the operational components of these hotels. These are just master lease to these casino operators. This is the most geographically diversified owner of gaming in the country. We'll be talking about VICI in a minute. I'm sure you all have questions about VICI as well. So they have the Gaming Legion has the largest number of gaming assets owned. They've also, just like VICI, they collected 100% of rents during COVID. So very solid business model here. Dividend yield is 6.4%. Price to AFFO is 12.6 times. Normal is 13.5. Looking at these fundamentals, again, you see a very steady earnings growth, very steady dividend growth. So I like gaming and leisure. I still like VICI better. We'll touch on VICI in a second. Next company, we have NetStreet, which is, by the way, the best performing net lease REIT this year in 2025. I also consider NetStreet an M&A target. The company has 705 properties in 45 states. That's about 12.8 million square feet, 106 properties, 52% investment grade. So logical buyer would be Realty Income in that area. Now, they have a weighted average lease term of about 9.6 years, so very stable. Their top tenants are Dollar General, CVS, Home Depot, Ahold. I used to build grocery stores for Ahold and Dollar Tree. You can see here, very steady growth. It's a new company. They basically went public during COVID, during 2020. They have a 4.8% dividend yield with a very low payout ratio of just 65%. They could pay out more dividend. They want to keep it lower. Again, that signals safety in this dividend. 4.8% yield. They're trading at 14 times. Even after the massive run up this year that I mentioned, they're trading at 14 times. Their normal valuation is closer to 18 times. So definitely NetStreet's a company you should have on the radar. Now we're going to go to Broadstone Net Lease, also an M&A target. 766 properties in 44 states and Canada. Weighted average lease term of 9.7 years. What's interesting with this company, they've done a lot of build-to-suit capital going into the space, which gives them $28 million of new rent through 2026. So a lot of visibility coming through their build-to-suit business. Also, they've grown their industrial exposure from 30% from a few years ago to over 60% today. Dividend yield is 6.2%. You can see here on the chart, they've also grown this. They are not as new. Actually, I knew the founder of that company, Amy Tate. She's no longer involved in the company, but I've watched the company move from a private REIT now into the public market. So 6.2% dividend yield, price to AFFO 12.8 times. Then we have Alpine Net Lease. Ticker is Pine. Again, this is also an M&A target. The company is externally managed by CTO, and we've written about that quite a bit. I don't really generally like externally managed companies. I think that's one of the reasons that Alpine should consider selling the company or being acquired, becoming an M&A target of such. There's 129 properties here with Alpine in 34 states. Weighted average lease term 8.9 years. 51% of their portfolio is investment grade. Again, that makes them an acquisition target for companies like Agree Realty or Realty Income. Top tenants on their list are companies like Dick's, Lowe's, Family Dollar, Walgreens, and Best Buy. Dividend yield is 7.3%. Trading at 11.3 times, so it's a pretty cheap company. One of the things I don't like about the company, they've recently made some lending investments. More recently, they loaned a company $24 million to fund the redevelopment of a former retail building in San Francisco to convert it to an industrial property. That comes along with 11% interest rate, so definitely getting some yield enhancement. But again, that's moving outside of their circle of competence, and investors should understand that's a riskier part of the business model. You can see on the chart, they've actually done decently, although the earnings have been kind of lumpy, and the dividend has been, the payout ratio has been problematic from time to time. But I like the company today, and I think the company is, worth 7.3% dividend yield. I don't think you're going to get tremendous price appreciation. I would be looking for a takeout here. Curbline Properties, this is the next one, ticker Curb. What they do is they invest in companies, freestanding companies that are within shopping centers. That they came up with this name Curb because they have curb appeal. There's 78 assets, 96% leased, fairly geographically diversified. Again, this is a low dividend payer. You can see there's not a lot of history in this company. They just listed 2024 or 2023, 2.8% dividend yield with a payout ratio of 72%. However, one of the interesting things about this company, analysts are forecasting growth of low double digits in 26 and 27. So that one may be worth a nibble there as well. Now, I believe this is the last one, or we have two more left. We have Front View, FVR, 319 properties in 37 states. This is also a new company we've been covering since they listed last year. They've got a weighted average lease term of 7.3 years. Biggest differentiator for this company, they're one of the most diversified net lease REITs. They've got, hundreds of different tenants in their portfolio. For example, their top tenant is Dollar Tree. They've got Verizon, IHOP. They've got a lot of franchise credit in there as well. So you don't have a predominant amount of investment grade, but you do have this diversification. Dividend yield on the company is 6.4%. Now, last in the JV squad is WP Carey. And by the way, WP Carey would have been on the varsity team, which is the Fab Five I'm going to talk about next. But the company did cut its dividend, and so we moved them back to the JV team. WP Carey has 1,600 properties today in North America and Europe. Weighted average lease term of 12.8 years, occupancy at 98.2%. The company's got 21.8% investment grade. Now, they pioneered this sell-leaseback business. These are big corporate sell-leasebacks where the companies will sell and lease back. Actually, one of their companies used to be the New York Times building in New York City, and New York Times sold it to them, leased it back. Now, I don't believe they own it today, but that's just as an example of that. I knew Bill Carey, the founder, before he passed away. Now, you can see on this chart, again, the company did cut its dividend. It had a very stellar record of growing the dividend for investors, but they cut it because essentially they wanted to remove their office exposure, which they did. They spun out the office buildings. They had to right size or really cut that dividend. So now they're on track. Maybe they'll be on the JV team soon. Now, Nick, you have any questions? And then I'm going to move very quickly onto the Fab Five.
Yeah, no questions. I was going to give you a break here. I don't think I've talked in about 20 minutes, but this is one of the most enjoyable Wide Moat shows that I've participated in. This is Brad Thomas Unleashed. I feel like we've got the nation's leading REIT guru over here, all hopped up on Mountain Dew, doing his best to race against the clock. What do you got there? Oh, he's healthier. Okay. All right. Got some orange juice.
Citrus punch.
There you go. But look, this is great. I'd love if we could have spent 3 hours doing this, going back and forth, really breaking these down, Brad. But I think you're doing a great job of, giving everybody what they need to know about these companies. And I've got some good ideas maybe for my portfolio. I've talked about interest rates are falling. I might have to figure out something to do with my cash, right? Right now, I'm very happy just to collect 4 to 5% in risk-free income. But if rates get cut a few times and that's 3%, I'm going to have to put that money somewhere. I think some of these JV team REITs are an option for me. I was interested in some of what you had to say. And I have a feeling I probably own most of the varsity REITs, but we'll see what they are here. And I'm looking forward to the last 5 minutes of this video here. So let's see what you got.
All right. National Retail Properties, actually NNN REIT, as they call themselves. Company has 3,663 properties across 50 states, leased to 400 tenants. Very diversified business model. 98% occupied portfolio. So they've maintained very, very solid occupancy for a long time, over 30 years. Top tenants include companies like 7-Eleven, Mr. Car Wash, Dave & Buster's, Camping World, a lot of different franchises, Taco Bell, Arby's, et cetera, et cetera. So, they are at the highest quality in terms of investment grade. But what I like about NNN is they've been able to landlord to these companies that eventually have converted to investment grade. So, which actually helps the valuation because those cap rates improve for those companies as they acquire them. Now, I will tell you, there's some car wash exposure. I've done some research on Mr. Car Wash. That's the number 2 tenant. That's actually a very good business model. But obviously, the car wash industry has been under a lot of pressure due to supply and demand, and more supply than demand. And we've seen a bankruptcy and some sales within the car wash industry, obviously driven by private equity. But anyway, I think National Retail, NNN, has done a great job of managing risk in the portfolio, as evidenced by the fact the company has increased its annual dividend for 36 consecutive years in a row. That puts them well beyond being a dividend aristocrat, which is 25 years, and moving closer and closer on to become a dividend king, which is 50 years in a row. So there aren't many companies that have that have achieved that success. Look at this chart here. You can see the company has definitely, even during COVID, when you see the pullback, the blue line coming down, that's the earnings, but they still maintain that dividend. Even though they had some rent checks not coming in during COVID, they were still able to maintain that dividend because they had plenty of cushion within their payout ratio. So NNN is definitely a very defensive company. A dividend yield today is 5.5%. Shares trading at 12.7 times. Normal valuation is 14.8 times. I actually put a fast graph in each of these last 5 just to demonstrate the value range. You can see that margin of safety. I believe NNN has the potential to generate returns of around 20% over the next 12 months. Again, take that 5.5% dividend, take the growth, which is probably 3-4% growth, and then their price appreciation. But again, set off by this catalyst called rate cuts. Now we're going to go to number 2 in the Fab Five is Agree Realty ADC. Do you agree with me? 2,513 properties in 50 states, 52 million square feet. Now, I've been covering this company really since the Great Recession. I've known Joey Agree and his father, who used to be running the company. Now Joey runs the company. They've evolved this business model. At one time, they were a landlord to Borders Books and Kmart and some other lower quality companies. But the management team there, Joey and his father, recognized that the company really had to create a more durable income stream, so they wouldn't have to go through another Great Recession or COVID with a dividend cut, because they were forced to cut the dividend during the Great Recession because of these troubled tenants. So now they've improved their portfolio substantially. They've got companies like Lowe's and Walmart and Wawa, Home Depot in the portfolio, 68% investment grade. So one of the best, highest quality portfolios in terms of investment grade tenants. They also have this sliver or this slice of ground leases. About 10% of their rental comes from in the form of ground leases. That's 232 ground leases. That's an extremely durable business model. In fact, this week in the Wide Moat Daily, I'll be talking about how to invest in land, and I'll talk about how to invest in ground leases, just like Agree Realty does. But look at this chart. I mean, yeah, the Great Recession certainly saw that dividend cut, but since then, they've not only grown it, they've increased that payout ratio, widened that payout ratio, a lot safer dividend, 4.2% dividend yield, shares trading at 17.2 times. Their normal range is 19.3 times. You can see here on the fast graphs how cheap the shares are. There is a margin of safety here. I believe Agree could return around 15%, possibly 20% over the next 12 months. Number 3, Fab Five, Essential Properties Realty, ticker EPRT, 2,190 properties in 48 states. Weighted average lease term, 14.3 years, 99.6% lease. Now, what really is fascinating with Essential Properties is they don't have a whole lot of investment grade. These are mostly franchise credit type tenants, and they do have a fairly decent size of car wash exposure in the portfolio. However, the payout ratio is the lowest in the sector. You can see here on this chart, they've been able to grow their earnings and their dividends since they listed shares just in 2018 or 19, but their payout ratio is continuing to get wider and wider. Right now, 64% payout ratio. So again, with the 3.9% dividend yield, price to AFFO at 16.8 times, normal is 18.5 times. You can see it on the chart. And by the way, consensus growth in 2026 is 9%. So really, really good growth in 26 forecasted. I believe this company could return 20% over the next 12 months. Number 4, VICI Properties. I mentioned VICI earlier, comparing it to gaming and leisure. VICI is not a pure play casino REIT anymore. They've moved beyond that into experiential elements of the business. So they lease they've got some wellness facilities. They've got a pier in New York. I visited a couple of times. They've got bowling alleys in the portfolio. So they've been moving and expanding the portfolio. So it's just not 100% related to casinos. I will tell you, recently I did an interview with the CEO, Ed Petoniak, and for our members of the Wide Moat letter. So if you're interested in our business, please follow us at the Wide Moat Research. Follow us on the daily, and then you can start following us. And we've got, again, a lot of CEO interviews. I'm going to be doing more for Wide Moat Research, but I had a great interview with Ed Petoniak. Great management team. You can see the fundamentals displayed on this chart. They've been able to grow their earnings, grow that dividend, and reduce that payout ratio over time. Right now, the dividend yield, or improve that payout ratio, their dividend yield is 5.4%. Their multiple is 14.4 times versus the normal of about 16. So I see VICI returning 15 to 20% over the next 12 months. Last but not least, drum roll. Nick, do you know what this last pick is going to be?
I'm sure I do. I'm sure everyone does, but let's hear about it anyway.
Okay. Last but not least, we have Realty Income. Ticker symbol is O. One ticker, one letter, AKA the monthly dividend company. They actually have the legal rights for that, the monthly dividend company. This is the biggest. I showed you the market cap earlier in the earlier slide. I showed you 15,600 properties in all 50 states as well as Europe. So it's a very, very diversified business model. 90% of their total rent is resilient to economic downturns or isolated from e-commerce pressures. Now, their top tenants include 7-Eleven, Dollar General, Walgreens, Lifetime Fitness, Wynn Resorts, FedEx, on down the list. But it's a very diversified list of clients there. And you can see here on this chart, again, earnings growth, very consistent. Dividend growth, it goes from bottom to the top. And it'll keep going forward because this company has something unique. Their primary levers are scale. Again, they're the largest in cost of capital. They have a dominant cost of capital. They're A-rated balance sheet. And that's allowed the company to diversify more, continue to diversify. So the company does not have to see earnings decline in black swan events like COVID or great recessions like we saw in 2008, 2009. So they've been able to increase that dividend for over 25 years. They're also a dividend aristocrat just behind National Retail Properties. Dividend yield is 5.4%. Right now, the multiple is 14 times. Even though they've actually run up a little bit here in the last few months, they're still trading at a pretty cheap price of 14 times compared with their normal valuation of 18 times. So I see Realty Income returning somewhere in the 20 to 25% over the next 12 months. And that's on top of a 16% price increase we've seen year to date. There's the margin of safety. So there you have it. That's the masterclass on net lease REITs. I went a little bit over, but I hope Juan doesn't shoot me.
No, I think you did a great job. I'm looking forward to seeing what this looks like once it's all edited. 21 companies in 35 minutes. It doesn't get much better than that. I hope viewers enjoyed it. If you did, please like the video, subscribe to our channel. Brad and I both really want to thank everybody. We've been getting 600-800 subscribers a week now. So let's keep growing the channel. I love that. We went from 4,000 to 7,000 in less than a month. So here's on to bigger and brighter things at YouTube. And like Brett said, sign up for the Wide Moat letter. That's our daily free newsletter that we send out. Covers real estate, of course, but obviously all the sectors, all the income paying types of assets that we like to own. And then in the Wide Moat letter is where you'll find a lot of more in-depth analysis on some of our favorite companies, including several that we discussed in this video. So thank you guys so much for stopping by. And Brad, I'm not looking, whenever it's my turn to give a masterclass, I think you set the bar pretty high, and I'm a little not looking forward to having to try to one-up you, but we'll see. We'll see what people want to hear about in the future.
Great. Thank you, Nick. And thank you everyone for watching. Please drop us some comments below and we will try to answer them as quickly as possible. See you next week.
Thank you guys. See ya. Thank you for tuning in to this week's episode of the Wide Moat Show here on YouTube. If you enjoyed our content, please like and subscribe to our channel and leave a comment. We'll be sure to get back to you ASAP. Also, please sign up for the Wide Moat Daily. That's our free daily newsletter at widemoatdaily.com. That's where you'll find Brad and I's insights on all sorts of things published every day in the evening. So thank you guys for stopping by, and we'll see you next week. Happy Swan investing.